Question 1. Which of the following actions must an options principal take before the first options trade can be executed in a customer's account? A. Obtain the customer's signed options agreement. B. Receive written supervisory approval of the account. C. Verify that the customer has sufficient funds to cover potential losses. D. Provide the customer with a personalized options strategy recommendation. Answer: B. Receive written supervisory approval of the account. Explanation: before any options transactions can occur, a registered options principal (ROP) must review and approve the options account in writing. This approval signifies that the principal has assessed the customer's suitability for options trading based on financial information, investment objectives, and experience. Other steps like obtaining the signed options agreement, verifying funds, or providing recommendations occur after or alongside the initial approval process. The core takeaway is that principal approval is a prerequisite for executing the first options trade, ensuring proper oversight from the outset. Question 2. The options disclosure document (ODD) must be provided to a customer at which of the following times? A. At least 15 days prior to account approval. B. At or before the time the customer's account is approved for options trading. C. Only upon request by the customer. D. After the first options trade has been executed. Answer: B. At or before the time the customer's account is approved for options trading. Explanation: FINRA rules mandate that the options disclosure document (ODD) be furnished to a customer at or before the time their options account is approved for trading. This ensures the customer receives comprehensive information regarding the risks and characteristics of options contracts before they are able to engage in any options transactions. Providing the ODD upfront is a critical investor protection measure, allowing customers to make informed decisions about the complex nature of options trading. This rule emphasizes proactive disclosure rather than reactive provision or solely upon customer request. Question 3. A registered options principal (ROP) reviewing a customer's account for suitability for uncovered call writing should pay closest attention to which of the following factors? A. The customer's current tax bracket. B. The customer's objective of generating income. C. The customer's net worth and investment experience. D. The customer's interest in diversifying their portfolio. Answer: C. The customer's net worth and investment experience. Explanation: uncovered call writing carries unlimited risk, as the potential loss is theoretically infinite if the underlying stock rises significantly. Therefore, a registered options principal (ROP) must scrutinize the customer's financial capacity, specifically their net worth, and their sophisticated investment experience to ensure they can understand and withstand such substantial risks. While income generation might be an objective, and diversification is generally good, these are secondary to the customer's ability to absorb potentially catastrophic losses. The practical takeaway is that high-risk strategies demand a deep assessment of a customer's financial wherewithal and understanding. Question 4. What is the primary responsibility of a registered options principal (ROP) regarding discretionary options accounts? A. To execute all trades personally within the account. B. To obtain a separate written power of attorney for each discretionary trade. C. To ensure that all discretionary trades are suitable and are reviewed promptly and frequently. D. To allow the registered representative complete autonomy in managing the account. Answer: C. To ensure that all discretionary trades are suitable and are reviewed promptly and frequently. Explanation: for discretionary options accounts, the registered options principal (ROP) holds a significant supervisory responsibility to ensure that all trades executed by the registered representative are suitable for the customer. This involves rigorous and frequent review of trades, typically at least daily, to confirm they align with the customer's investment objectives and risk tolerance, and to detect any potential abuses or unauthorized activity. While a power of attorney is required to establish discretion, it is not needed for each trade, and allowing complete autonomy would be a dereliction of supervisory duty. The takeaway is that discretion in options accounts demands heightened principal oversight due to the inherent risks involved. Question 5. According to FINRA rules, all options-related retail communications must be approved by a registered options principal (ROP) prior to first use, with the exception of which of the following? Educational material describing basic options strategies. B. Form letters sent to existing clients regarding new options products. C. Advertisements promoting a specific options trading seminar. D. Correspondence to a single retail customer that is not a template. Answer: D. Correspondence to a single retail customer that is not a template. Explanation: FINRA Rule 2210 generally requires that all retail communications be approved by a qualified principal prior to use. However, a specific exception exists for correspondence directed to a single retail customer, provided it is not a template or form letter and does not exceed a certain number of recipients, typically 25 in a 30-day period. This distinction acknowledges the personalized nature of one-on-one communication versus broader public outreach. The practical takeaway is that while most public-facing options materials require principal pre-approval, isolated, personalized communications to individual clients may be exempt from this specific pre-use approval, though they are still subject to supervision and review. Question 6. A customer who writes an uncovered call option faces which of the following risks? A. Limited loss potential if the underlying stock price declines significantly. B. Unlimited loss potential if the underlying stock price increases significantly. C. Loss of the premium paid if the option expires out of the money. D. The obligation to buy the underlying stock at the strike price if assigned. Answer: B. Unlimited loss potential if the underlying stock price increases significantly. Explanation: when a customer writes an uncovered, naked, call option, they do not own the underlying stock. If the stock price rises above the strike price, the writer is obligated to deliver the shares, which they must then purchase in the open market, potentially at a much higher price. This creates a theoretically unlimited loss potential, as there is no cap on how high the stock price can climb. Understanding this extreme risk is crucial for principals when approving and supervising such accounts. The practical takeaway is that uncovered call writing is one of the riskiest option strategies due to its unbounded loss potential. Question 7. Which of the following describes the purpose of options position limits? A. To limit the total number of options contracts an individual customer can hold across all underlying securities. B. To prevent any single investor or group from exercising undue influence on the price of an underlying security through options trading. C. To restrict the total number of options contracts written by a customer. D. To ensure that all options trades are executed within the same trading day. Answer: B. To prevent any single investor or group from exercising undue influence on the price of an underlying security through options trading. Explanation: options position limits are established by the exchanges and regulatory bodies to restrict the maximum number of options contracts that an individual or group of affiliated individuals can hold or control on the same side of the market for a given underlying security. The primary purpose is to prevent excessive concentration of positions that could manipulate the market price of the underlying asset or the options themselves. These limits are designed to promote fair and orderly markets and protect against potential market disruptions. The practical takeaway is that position limits are a key regulatory tool to maintain market integrity and prevent manipulative practices in options trading. Question 8. Who is primarily responsible for ensuring that a firm's supervisory procedures for options trading are adequate and effectively implemented? A. The firm's chief financial officer. B. The firm's legal counsel. C. A registered options principal (ROP). D. The Financial Industry Regulatory Authority (FINRA). Answer: C. A registered options principal (ROP). Explanation: A registered options principal (ROP) holds the primary responsibility for the establishment, maintenance and enforcement of a firm's supervisory procedures concerning options trading. This includes ensuring that the firm's policies and procedures are adequate to comply with all applicable options rules and regulations, and that they are effectively implemented throughout the firm. While other individuals and entities play roles in a firm's overall operations and compliance, the ROP is specifically designated for options supervision. The practical takeaway is that the ROP is the linchpin for options compliance, directly accountable for the firm's adherence to regulatory standards in this complex area. Question 9. If a customer wishes to open an options account for a trust, which of the following documents would an ROP typically require for approval? A. A notarized letter from the trust beneficiary. B. A copy of the trust agreement. C. Proof of residence for the trustee. D. A personal financial statement of the grantor. Answer: B. A copy of the trust agreement. Explanation: when opening an options account for a trust, the registered options principal (ROP) must review the trust agreement. This document outlines the powers granted to the trustee, the beneficiaries, and any specific limitations on investment activities, including the ability to trade options. The trust agreement is crucial for establishing the legal authority of the trustee to engage in options trading and for ensuring that such activities are consistent with the trust's objectives. The practical takeaway is that for fiduciary accounts, understanding the governing legal document is paramount to ensure proper authorization and suitability. Question 10. Which of the following is considered a key factor when a registered options principal (ROP) evaluates the suitability of an options strategy for a customer? The current market volatility of the underlying asset. B. The broker-dealer's proprietary research on the underlying asset. C. The customer's investment objectives, financial situation, and risk tolerance. D. The commissions generated by the proposed options trades. Answer: C. The customer's investment objectives, financial situation, and risk tolerance. Explanation: the evaluation of suitability for any investment, especially options, fundamentally revolves around understanding the customer's specific circumstances. A registered options principal (ROP) must assess the customer's stated investment objectives, e.g., income, growth, speculation, their current financial situation, e.g., income, net worth, liquid assets, and their willingness and ability to take on financial risk. While market volatility and research can inform strategy selection, and commissions are a business outcome, these do not supersede the primary importance of aligning the investment with the customer's personal profile. The practical takeaway is that client-centric suitability analysis remains the bedrock of ethical and compliant options supervision. Question 11. FINRA rules require that a firm's supervisory system for options accounts must include: A. Daily approval of all options trades by a senior ROP. B. Written procedures for reviewing options accounts and transactions. C. Mandatory quarterly meetings with all options customers. D. The use of a proprietary software for all options order entry. Answer: B. Written procedures for reviewing options accounts and transactions. Explanation: a robust supervisory system for options accounts, as required by FINRA, necessitates the establishment of clear written procedures for the review of options accounts and transactions. These procedures outline how registered representatives and principals must handle account opening, suitability determinations, order entry, and ongoing account monitoring. While daily approval of all trades might be excessive, regular and timely review is essential, and written procedures ensure consistency and accountability. The practical takeaway is that documented processes are fundamental to effective supervision, providing a framework for compliance and risk management in options trading. Question 12. When must a customer sign and return the options agreement after their account has been approved for options trading? Before the first options trade is executed. B. Within 30 days of the account being opened. C. Within 15 days of the account being approved. D. Only if they wish to write uncovered options. Answer: C. Within 15 days of the account being approved. Explanation: FINRA rules stipulate that after a customer's options account has been approved by a registered options principal, the customer must sign and return the options agreement within 15 calendar days. This agreement formally acknowledges that the customer has received the options disclosure document (ODD) and understands the risks involved in options trading. While the account can be approved and the first trade executed before the signed agreement is returned, failure to return it within 15 days will result in the account being restricted to closing transactions only. The practical takeaway is that timely return of the options agreement is crucial for maintaining full trading privileges in an options account. Question 13. An ROP discovers a series of options trades in a customer's account that appear inconsistent with the customer's stated investment objectives and risk tolerance. What is the ROP's most appropriate immediate action? A. Liquidate the positions to minimize further risk. B. Contact the customer immediately to discuss the trades. C. Discuss the trades with the registered representative and determine the suitability basis. D. Do nothing as the trades have already been executed. Answer: C. Discuss the trades with the registered representative and determine the suitability basis. Explanation: upon identifying potentially unsuitable options trades, the registered options principal (ROP) must promptly investigate the situation. The most appropriate immediate step is to discuss the trades with the registered representative responsible for the account to understand the rationale and suitability basis behind the transactions. This allows the ROP to gather all relevant facts before taking further action, such as contacting the customer or considering corrective measures. The principal's role is investigative and corrective, not merely passive observation or hasty liquidation. The practical takeaway is that a principal's first response to red flags is to gather information from the involved parties to determine the full scope of the issue. Question 14. Which of the following is a key characteristic of municipal bond options? A. They are listed and traded on national securities exchanges. B. Their value is primarily derived from interest rate movements affecting the underlying municipal bonds. C. They are typically used for highly speculative purposes only. D. They are exempt from ODD delivery requirements. Answer: B. Their value is primarily derived from interest rate movements affecting the underlying municipal bonds. Explanation: options on municipal bonds derive their value significantly from changes in interest rates, which directly impact the price of the underlying municipal bonds. As interest rates rise, bond prices generally fall and vice versa. These options allow investors to speculate on or hedge against interest rate movements. Unlike equity options, they are not typically listed on national securities exchanges and are not exempt from appropriate disclosures. The practical takeaway is that understanding the unique underlying asset and its price drivers is essential when supervising options on municipal bonds. Question 15. What is the primary role of the Options Clearing Corporation (OCC) in the options market? A. To set options prices and determine strike prices. B. To regulate options exchanges and broker-dealers. C. To issue, guarantee and clear options contracts. D. To provide investment advice to options traders. Answer: C. To issue, guarantee and clear options contracts. Explanation: the Options Clearing Corporation (OCC) serves as the issuer, guarantor and clearinghouse for all listed options contracts in the United States. It standardizes options contracts, ensures the performance of contracts by acting as the counterparty to every trade, and significantly reduces counterparty risk for market participants. The OCC does not set prices, regulate firms, or provide investment advice. Its central role is crucial for the integrity and efficiency of the options market. The practical takeaway is that the OCC is the foundation of the standardized options market, enabling widespread and secure options trading. Question 16. Which of the following describes a key supervisory responsibility of an ROP regarding options customer complaints? A. To personally resolve every customer complaint without involving the registered representative. B. To ensure all options complaints are reviewed, investigated and properly handled in accordance with firm procedures and regulatory rules. C. To immediately report all options complaints to the SEC without further investigation. D. To dismiss complaints that appear minor or unfounded. Answer: B. To ensure all options complaints are reviewed, investigated and properly handled in accordance with firm procedures and regulatory rules. Explanation: A registered options principal (ROP) has a critical supervisory responsibility to ensure that all options-related customer complaints are handled thoroughly and compliantly. This involves reviewing, investigating, and responding to complaints in accordance with the firm's established procedures and FINRA rules. The ROP must ensure proper documentation and, if necessary, escalate the complaint to appropriate regulatory bodies. Dismissing complaints without proper review or automatically reporting to the SEC are not appropriate first steps. The practical takeaway is that complaint handling is a serious principal responsibility requiring diligence, adherence to process, and a commitment to investor protection. Question 17. When a call option holder decides to exercise their option, what is the primary obligation of the call option writer? A. To purchase the underlying shares from the option holder. B. To deliver the underlying shares to the option holder at the strike price. C. To pay the option holder the difference between the strike price and the market price. D. To cancel their option position immediately. Answer B. To deliver the underlying shares to the option holder at the strike price. Explanation. When a call option holder exercises their option, the call option writer, who sold the option, is obligated to deliver the underlying shares to the option holder at the agreed-upon strike price. This is known as assignment. The Options Clearing Corporation (OCC) facilitates this process by randomly assigning exercise notices to clearing members who are then responsible for assigning their customers who are short the option. This obligation is a fundamental aspect of writing options. Question 18. Which of the following is most accurate regarding margin requirements for uncovered short options positions? A. They typically require 100% of the premium received as margin. B. They are generally lower than margin requirements for covered options positions. C. They are typically higher due to the unlimited risk potential. D. They are exempt from Regulation T requirements. Answer C. They are typically higher due to the unlimited risk potential. Explanation. Uncovered short options positions such as uncovered call writing carry theoretically unlimited risk. Consequently, the margin requirements for these positions are significantly higher than for covered options positions or for buying options. These higher margin requirements are mandated by regulatory bodies like the Federal Reserve, Regulation T, and FINRA to ensure that investors have sufficient capital to cover potential losses. They are not exempt from Regulation T. The practical takeaway is that the greater the risk of an option strategy, the higher the margin requirement, reflecting the need for adequate financial backing. Question 19. When an ROP approves a new options account, which of the following statements regarding the documentation of the suitability determination is true? A. The ROP's approval solely relies on the customer's verbal affirmation of understanding the risks. B. The firm must maintain a written record demonstrating the basis for the ROP's suitability determination. C. Suitability documentation is only required for margin accounts, not cash options accounts. D. The customer is responsible for documenting their own suitability. Answer B. The firm must maintain a written record demonstrating the basis for the ROP's suitability determination. Explanation. FINRA rules require that firms maintain a written record demonstrating the basis for the Registered Options Principles (ROP) determination that an options account and the proposed trading strategies are suitable for the customer. This written documentation is crucial for compliance, supervisory oversight, and demonstrating due diligence in the event of regulatory scrutiny. Verbal affirmations are insufficient, and suitability applies to all options accounts, not just margin. The customer is not solely responsible for this documentation. The practical takeaway is that formal, documented suitability assessments are a cornerstone of options account approval. Question 20. Which type of options communication with the public is subject to the most stringent approval and filing requirements? A. Internal memos to registered representatives. B. One-on-one correspondence with individual customers. C. Retail communications such as advertisements and sales literature. D. Instant messages exchanged between two registered representatives. Answer C. Retail communications such as advertisements and sales literature. Explanation. Retail communications, which include advertisements, sales literature, and independently prepared reprints intended for a mass audience, more than 25 retail investors within a 30-day period, are subject to the most stringent approval and filing requirements. These materials must be approved by a Registered Options Principal (ROP) prior to use and in many cases, may need to be filed with FINRA. This strict oversight is due to their broad reach and potential to influence a large number of investors. The practical takeaway is that any broadly disseminated options material requires careful principal review and potential regulatory filing to ensure accuracy and compliance. Question 21. While related to position limits, exercise limits specifically restrict which of the following for options traders? A. The total value of options contracts that can be held across all accounts. B. The maximum number of options contracts that can be exercised within a specified period for a single underlying security. C. The cumulative premium paid for all options positions held over a year. D. The number of new options contracts that can be opened in a single trading day. Answer B. The maximum number of options contracts that can be exercised within a specified period for a single underlying security. Explanation. Exercise limits are regulatory restrictions that specify the maximum number of options contracts that an individual or group of affiliated individuals can exercise within a 5 consecutive business day period for a given underlying security. This is distinct from position limits, which restrict the total number of options contracts that can be held. Both types of limits serve to prevent market manipulation and maintain fair and orderly markets, but exercise limits specifically target the impact of large-scale exercising of options on the underlying security. Question 22. An ROP supervising a registered representative who frequently recommends complex option strategies to customers should prioritize which of the following? A. Ensuring the representative achieves high commission payouts. B. Verifying the representative's personal options trading profits. C. Reviewing the suitability of each recommendation for every client and the representative's understanding of the strategies. D. Only reviewing accounts with negative returns. Answer. C. Reviewing the suitability of each recommendation for every client and the representative's understanding of the strategies. Explanation. When a registered representative frequently recommends complex option strategies, the ROP's paramount duty is to meticulously review the suitability of each recommendation for every client. This includes ensuring that the client fully understands the risks involved and that the strategy aligns with their financial situation and objectives. Additionally, the ROP must verify that the representative himself possesses a thorough understanding of the complex strategies they are recommending. This proactive oversight is crucial to prevent unsuitable recommendations and potential investor harm. The practical takeaway is that complex products require heightened scrutiny of both client suitability and representative competency. Question 23. Which of the following would generally not be considered a permitted activity for a customer in a cash options account? A. Buying call options. B. Buying put options. C. Writing covered call options. D. Writing uncovered call options. Answer. D. Writing uncovered call options. Explanation. A cash options account permits buying options, calls or puts, and writing covered calls, where the writer owns the underlying stock to cover the potential assignment. However, writing uncovered, naked, call options is strictly prohibited in a cash account because it carries theoretically unlimited risk and requires significant margin to cover potential losses. Uncovered option strategies are only permissible in a margin account that has been approved for such activity. The practical takeaway is that cash accounts are restricted to strategies with defined, limited risk, such as buying options or writing covered calls. Question 24. When a customer grants discretionary authority to a registered representative to trade options, which of the following is required? A. Oral approval from a registered options principal for each trade. B. The customer's written authorization and approval by a registered options principal. C. The customer's signature on the options agreement, nothing more. D. Only the registered representative's approval. Answer. B. The customer's written authorization and approval by a registered options principal. Explanation. To establish a discretionary options account, 2 key elements are required: the customer's specific written authorization granting discretion to the registered representative, and the subsequent written approval of this discretionary authority by a registered options principal, ROP. This dual approval ensures that the customer consciously delegates control and that a supervisor reviews and approves the delegation. Oral approval for each trade is insufficient, and neither the options agreement alone nor the representative's sole approval establishes valid discretion. The practical takeaway is that discretionary accounts require explicit written consent from the customer and robust principal oversight to protect against potential abuses. Question 25. Which option strategy involves buying both a call and a put with the same strike price and expiration date on the same underlying asset? Straddle. B. Spread. C. Collar. D. Butterfly. Answer A. Straddle. Explanation. A straddle is an option strategy created by simultaneously buying both a call and a put option on the same underlying asset, with the same strike price and the same expiration date. This strategy is employed when an investor anticipates a significant price movement in the underlying asset but is uncertain about the direction of that movement. A straddle profits from large price swings, whether up or down, while incurring losses if the underlying price remains stable. Understanding common option strategies is fundamental for principals in reviewing customer accounts for suitability. The practical takeaway is that straddles are a volatility play, profiting from large movements in either direction. Question 26. A registered options principal, ROP, must ensure that which of the following trade reporting requirements are met for options transactions? A. Trades are only reported to the customer if a profit is realized. B. All options transactions are reported to the appropriate regulatory body and clearing firm promptly and accurately. C. Only discretionary trades require official reporting. D. Trade reports are sent out quarterly, regardless of activity. Answer: B. All options transactions are reported to the appropriate regulatory body and clearing firm promptly and accurately. Explanation: ROPs are responsible for ensuring that all options transactions are reported accurately and promptly to the relevant regulatory bodies, e.g., FINRA exchanges, and the Options Clearing Corporation, OCC. This includes proper trade confirmation delivery to customers, maintaining complete audit trails, and adhering to reporting deadlines. Accurate and timely reporting is crucial for market surveillance, regulatory oversight, and customer protection. This responsibility applies to all trades, not just discretionary ones, and reporting is typically more frequent than quarterly for active accounts. Question 27. In a branch office, what specific action might an ROP take to fulfill their ongoing supervisory duties related to options trading? A. Conduct daily trading sessions for all options customers to demonstrate strategies. B. Regularly review customer account activity reports and representative blotters for suitability and unauthorized trading. C. Delegate all options supervision tasks to non-registered administrative staff. D. Solely focus on the profitability of the options department. Answer: B. Regularly review customer account activity reports and representative blotters for suitability and unauthorized trading. Explanation: A key aspect of an ROP's ongoing supervisory duties in a branch office is the regular review of customer account activity reports and representative transaction blotters. This proactive monitoring helps identify potential issues such as unsuitable recommendations, excessive trading, churning, or unauthorized trading. Effective supervision requires continuous vigilance over trading activity to ensure compliance with firm procedures and regulatory rules, protecting both the firm and its customers. Delegating core supervisory tasks to unqualified staff or focusing solely on profits would be a dereliction of duty. Question 28. Which of the following is typically a critical factor when assessing the suitability of options for a customer's retirement account, e.g., IRA? A. The customer's desire for tax-free income. B. The conservative nature of retirement accounts, generally limiting complex or high-risk option strategies. C. The ability to use unlimited margin for options positions. D. The automatic approval of all option strategies due to tax advantages. Answer: B. The conservative nature of retirement accounts, generally limiting complex or high-risk option strategies. Explanation: Retirement accounts such as IRAs are generally established for long-term growth and capital preservation, making their nature conservative. Consequently, complex or high-risk option strategies like uncovered call writing or highly leveraged spreads are typically considered unsuitable due to their potential to generate significant losses that could jeopardize retirement savings. While specific rules may vary, the general principle is to prioritize capital preservation in these accounts. The practical takeaway is that the primary objective of retirement accounts often restricts the permissible option strategies to more conservative ones, such as covered calls or protective puts. Question 29. Under FINRA rules, how often must a firm's supervisory procedures concerning options activities be reviewed by a qualified principal? A. Only when new regulations are introduced. B. At least annually. C. Every 5 years. D. Upon specific request from FINRA. Answer: B. At least annually. Explanation: FINRA rules require that a firm's written supervisory procedures, including those pertaining to options activities, be reviewed and updated at least annually by a qualified principal. This annual review ensures that the procedures remain current, effective, and compliant with evolving regulations and business practices. It is a critical component of a firm's overall supervisory system to maintain robust internal controls. The practical takeaway is that regular, at least annual, review of supervisory procedures is mandatory to ensure ongoing compliance and adapt to market and regulatory changes. Question 30. A firm's procedures for monitoring options trading should be designed to detect which of the following? A. Only instances of customer complaints. B. Excessive activity, churning, and other potential abuses. C. Only trades that result in losses for the customer. D. All trades executed by the firm's market makers. Answer B. Excessive activity, churning, and other potential abuses. Explanation. A firm's options monitoring procedures must be comprehensive, designed to detect a wide range of potential abuses, including excessive trading, churning, unsuitable recommendations, unauthorized trading, and other fraudulent or manipulative activities. Focusing only on complaints or losses would be insufficient, as many abuses may go unreported or temporarily appear profitable. The goal is proactive surveillance to protect customers and maintain market integrity. The practical takeaway is that effective supervision involves continuous monitoring for patterns or activities that suggest misconduct, not just reacting to adverse outcomes. Question 31. If a corporate action such as a reverse stock split affects an underlying stock, who is primarily responsible for determining how outstanding options contracts will be adjusted? A. The broker-dealer where the options were traded. B. The customer who owns the options contracts. C. The Options Clearing Corporation (OCC). D. The exchange where the options are listed. Answer: C. The Options Clearing Corporation (OCC). Explanation: the Options Clearing Corporation (OCC) is solely responsible for determining the adjustments made to outstanding options contracts due to corporate actions affecting the underlying securities, such as stock splits, reverse splits, or mergers. The OCC's role as the issuer and guarantor ensures standardized and consistent adjustments across the entire options market. Broker-dealers and customers do not make these determinations. The practical takeaway is that the OCC's central role includes standardizing corporate action adjustments, maintaining fairness and order in the options market. Question 32. Which of the following is an unacceptable practice for a registered options principal when supervising options advertising? A. Reviewing all advertising materials for fairness and balance. B. Approving advertising that makes exaggerated claims about potential profits. C. Ensuring all risk disclosures are clearly and prominently presented. D. Requiring disclaimers regarding the volatility of options. Answer: B. Approving advertising that makes exaggerated claims about potential profits. Explanation: A registered options principal (ROP) is strictly prohibited from approving advertising that contains exaggerated claims about potential profits or minimizes the risks associated with options trading. FINRA rules require that all communications with the public be fair, balanced, and not misleading, especially concerning complex and risky products like options. Approving such misleading advertising would be a serious supervisory violation. The practical takeaway is that principals must act as gatekeepers, ensuring options marketing is truthful, accurate, and transparent, with a clear emphasis on risk disclosure. Question 33. Regarding market maker options accounts, a registered options principal must ensure that A. Market makers are always profitable. B. The accounts are used solely for bona fide market-making activities and not for speculative purposes unrelated to their role. C. Market makers are exempt from all position limits. D. All market maker trades are approved by the ROP prior to execution. Answer: B. The accounts are used solely for bona fide market-making activities and not for speculative purposes unrelated to their role. Explanation: A registered options principal (ROP) supervising market maker accounts must ensure that these accounts are exclusively used for bona fide market-making activities. This means the trading activity should be consistent with providing liquidity and maintaining a fair and orderly market, rather than being used for personal speculative purposes unrelated to their market-making obligations. While market makers do have certain exemptions, e.g. from some position limits, Their trading activities are still subject to strict regulatory oversight to prevent abuses. The practical takeaway is that the special privileges granted to market makers come with a strict obligation to use those privileges only for their intended market facilitating purpose. Question 34. Under FINRA rules, what is the required holding period for options-related retail communications? 1 year. B. 3 years. C. 5 years. D. 6 years. Answer B. 3 years. Explanation. FINRA Rule 2210 requires that firms retain all options-related retail communications, as well as evidence of principal approval, for a period of 3 years from the date of last use. This record-keeping requirement allows regulators to review a firm's historical communications to ensure compliance with advertising and suitability rules. Maintaining accurate records is a fundamental aspect of a firm's supervisory obligations. The practical takeaway is that meticulous record-keeping for all public communications is a non-negotiable compliance requirement for broker-dealers. Question 35. Which of the following describes a covered call option? A. A call option where the writer owns sufficient shares of the underlying stock to deliver if assigned. B. A call option written without owning the underlying stock. C. A call option that is in the money. D. A call option protected by a corresponding long put option. Answer. A. A call option where the writer owns sufficient shares of the underlying stock to deliver if assigned. Explanation. A covered call option refers to a call option contract written, sold, by an investor who simultaneously owns an equivalent number of shares of the underlying stock. If the call option is assigned, the writer can deliver the shares they already own, thereby limiting their risk. This strategy aims to generate income from the premium received while taking on less risk than an uncovered call. Understanding the distinction between covered and uncovered positions is crucial for principals when assessing risk and suitability. The practical takeaway is that covered implies the investor holds the underlying asset, mitigating the risk of obligation.